Today I would like to analyze Alphabet, one of the largest technology company in the world and probably one of the worst performing stocks in the last 3 months. We are down close to 25%, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the market cap of 1,863 billion US dollar. This makes Alphabet the 5th largest technology company in the world by the market cap. We also have a dividend yield of around 0.5%, but we cannot tell really much about it because it just started in 2024. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 182 billion US dollar. This was a strong increase around 12% from 2019. Then in 2021, we saw the incredible growth around 41%. In 2022, we saw the good growth around 10%. 2023, close to 9% growth. This is also good. And in 2024, we saw the strong growth around 14%. So in the last 5 years, we saw the good revenue growth, and it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 42.8 billion US dollar. This was an incredible growth, around 38% from 2019. In 2021, we saw the incredible growth again, around 56%. This is something we like to see. Then in 2022, we saw the decline around 10.45%. But if we take a look at the operating cash flow, we can just see a decline around 0.17%. So the reason for that is the higher capital expenditures. If we take a look at 2023, we saw a growth around 15.8% in the free cash flow. This is also very good. And in 2024, we saw the growth around 4.7%. This is also decent. So we can say in the last 5 years, we saw the very good free cash flow growth. So it's a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for an undervaluation. So we're going to take the free cash flow from 2024, 72.76 billion US dollar. We're going to divide it with the current market cap, 1,863. And then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 3.9%. And I think this is a decent number for a technology company. Of course, it's under the 4%, so it's not a check here. What we're also going to take a look at the future free cash flow as well. If we ask ChatGPT for future assumptions about the free cash flow, we can see here in 2025 around 76.4 billion US dollar, in 2026 around 90.5 billion US dollar, and in 2027 around 109 billion US dollar. So I'm not quite sure if these numbers are realistic. Let's assume for 2027 we can reach around 95 billion US dollar. Let me know in the comment section if you think this number is realistic. We're going to divide it with the current market cap, 1,863 billion. So then we're going to get the free cash flow yield for 2027 with our assumptions. The number we're going to get would be around 5.01%. So I think this is a very good number. Actually, it's a quite high free cash flow yield, and it would be over the 4%. So it would be a check here. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take the long-term debt. This around here, 10.89 billion US dollar. Then we're going to add the short-term debt as well. We can see here around 1 billion US dollar. We're going to divide it with the current free cash flow, 72.76 billion. Then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 0.16. So this means in not many months we can repay the debt with the free cash flow. So this a check here is something we like to see. And we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 95 billion US dollar. And this is an incredible amount. This is a lot of money they can use to invest in the business or to buy back their own shares. So we like to see that overall is a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation, the current market cap, 1,863. We're going to add the debt as well, 11.89 billion US dollar. We're going to take minus the cash, 95.33. So this is the enterprise valuation, how much the whole company is worth. So this number is around 1,779.56 billion. So this we're going to divide with the current free cash flow, 72.76. Then we're going to get the ratio around 24.45. So this is a great number actually for a technology company. So it's under 25, so it's a check here. We can also calculate this number for 2027 with our free cash flow assumptions. So then we're going to get a different number as well. So the number we're going to get would be around 18.73. So this number looks even better. So this is definitely an indication for undervaluation, especially for a technology company. So we like to see that. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. We can see here repurchase of common stocks. In 2020, it was around 31 billion US dollar, and we can see it increase over the years. So yes, this company buys back their own shares. We need to take a look at the stock-based compensation as well. This is how much shares the company gives to the employee. So we can see here in 2020 around 13 billion US dollar. So yes, the shares outstanding did decrease in the last 5 years. Can Alphabet stock be a good buy right now? So let's start with the positive. So we had a great revenue growth in the last 5 years. We also had a great free cash flow growth as well. This is something we really like to see. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. So they have a lot of money in the bank. This is something we like to see. The free cash flow yield around 3.9% is also decent for a technology company, I would say. With our free cash flow assumptions for 2027, it would be over 5%. This is something we like to see. Then the enterprise valuation to free cash flow ratio around 24.45 is also a decent valuation, I would say. We would like to see that number under 25. So in 2027, this number would be around 18.73, which could be an indication for undervaluation. Of course, we have the stock-based compensation. So the company gives the shares to the employee for the work. This is around 22.79 billion US dollar. So this is quite normal for a technology company, but of course, this is like a hidden cost as well. But I still consider Alphabet stock a decent buy right now. I think they can grow the free cash flow in the future, and the valuation was also way higher some months ago. So I think we can see some potential in the next years. If you found this video helpful, don't forget to like and comment and subscribe for more content.